Module 7 of your textbook talks about liabilities, current and long-term liabilities. And so just like with assets, a current liability is something that will be satisfied within 1 year and or technically one operating cycle, but we generally think of 1 year. And long-term liabilities are something that we don't have to satisfy until some time in the future beyond 1 year. Okay, so that's the differential between those. A lot of current liabilities occur because of trade debt and because of what we call accruals. So trade debt, which we've run into already, if we buy inventory from a supplier, it will be, we'll just have our debit will be inventory. And for our purposes, let's just say $100. And then we're going to have an accounts payable for $100. And we owe that supplier $100 within 30 days. And so that would be current because within 30 days or one accounting period. Okay, so that would be an inventory. But accruals are such things as, let's say that the end of the year, January or December 31st falls on a Wednesday. And we pay our workers weekly. So if we have 10 workers, they earn $20 an hour, work 8 hours a day, Monday through Friday. Come Wednesday, we're not going to pay them because it's not Friday. We're going to pay them on Friday like we always do. But we're going to have to book the accrual, which is going to be wage expense. So 10 workers times $20 an hour is $160 a day times 10 is $1,600 that we're going to owe the workers. So wage, and for 3 days, that would be $4,800. So wage expense will be $4,800, and then we'll have wages payable, $4,800. All right, so now what happens on Friday is we have 2 more days, $3,200, and so we're going to have wage expense, $3,200, wages payable, so that wipes out the $4,800, and then we'll have cash, $8,000. And so, but this, we would show a current liability for wages payable of $4,800. And we do that for everything from utilities, our trade accounts receivable or payable, insurance payable, whatever it might be that we owe on various things. We're going to do that for the current liabilities. And so that's pretty much that on the current liabilities. The other thing that we might have, we have deferred revenue, and that's like in one of the videos I referred to it as a masquerade account because it says it's a revenue, but it's really a liability. That's when we take a deposit in advance for somebody to do something. Maybe they special order something, and we don't want to be out too much money in case they don't come and pick it up. So we require a deposit, and so maybe on a $5,000 good, we would require them a $1,500 deposit. So we would take in cash of $1,500, and we would have an unearned revenue or deferred revenue of $1,500. Then the good comes in, we've ordered it, the good comes in, they come to pick it up. So they're going to give us cash again of $3,500. Then we'd have the unearned revenue of $1,500, and then we would have sales revenue of $5,000. This unearned revenue here is a liability, right? It doesn't become a revenue, a true revenue, until we delivered the good. All right. So that's pretty much it on the current, except for like most of you are familiar with either a car payment or a mortgage payment. So you're paying part of the principal currently plus the interest. Like with a bond, you pay only the interest until the last payment. If it was a retail transaction, we call it a balloon payment. But in bonds, we just call it the redemption of the bonds. And so if we issued $1 million in bonds, every at 5% interest every 6 months, we would pay 2.5%, half the 5%. We would pay 2.5%, or $25,000. And then on the last payment, we would pay not only the $25,000 interest, but we would also pay the $1 million face value of the bonds, the redemption of the bonds. Well, so that's a normal bond, but in things like mortgages and car payments and that sort of thing, you're paying part of the principal as you go. And so that current part of long-term debt, the principal that you're going to pay within the coming year when you issue your financial statements, is called the current portion of long-term debt. So you've got to take that into account. So that's pretty much the current liabilities. Let's take a look then at debts, pricing of debts. Okay. So in order to understand bonds, one of the things you have to understand is the way bonds are issued in this country. There are private placements and there are public placements. I know we're talking bonds, so it's not an initial public offering, but that would be a stock. But a public placement requires registration with the Securities and Exchange Commission. So 30 days prior to the issuance of the bonds, at least 30 days, could be a few more, usually not much more, they have to issue what's called a prospectus, sometimes called a red herring, because the printing on the face is in red, and it says this is not an offer to buy or sell securities. And so what happens is they have to set an interest rate 30 days in advance. But if you know anything about markets, interest rates fluctuate daily. This is one of the big things that's going on currently with the Treasury market, is the interest rates are fluctuating almost, hourly as to how much the interest rate will be. But they have to set that in advance, and they have to give all this information about the debt. So the chances of the interest rate that they set 30 days prior being the exact same amount that it is on the time they issue it is essentially zero. It's just not going to happen. If it does, it's totally coincidence. Now, if in a private placement, that's not true. They don't have to go through this red herring. So this is like, this would be something like the city of Midland going and financing all their bonds through an insurance company, right? so that they don't have to go through this registration. The SEC considers that an insurance company is a knowledgeable investor. They don't have to be protected. And so they can just issue a contract. And so they can negotiate an interest rate on the spot. And that's what it is. So the interest rate there will be exactly what the face interest rate is. So when we have a private placement, the issuance of bonds, let's say we're going to issue $10 million worth of bonds. We're going to receive cash of $10 million, and we're going to have bonds payable for $10 million. And that's all there is to it in a private placement, because the interest rate's exactly what we agreed to that time. But in a public placement, because of this registration 30 days in advance and all this kind of stuff, the interest rate is not going to be exactly what we state. So we're going to set an interest rate. Let's say for our purposes, that interest rate is 5%. And then come the day of issue, the actual interest rate in the market, and this is going to be a big fluctuation, just to make life easy. But the actual interest rate that the market demands is 4%. Okay, so I want to issue $10 million of face value, but I don't know exactly what's that going to, so 10 million times 0.05 is going to be 500,000. So that's the amount of interest that I pay every year. Now, in the United States, the normal, and when I say normal, like 95% of bonds issued in the United States pays interest semi-annually, every 6 months. So we divide this by 2, and it will be $250,000 every 6 months that I will pay that. And the face value is a simple interest. So if I say 5%, we're not dealing with compounding and all that other stuff. If I say it's a 5% bond, it's going to pay $250,000 every 6 months until the bond matures. Okay. And so, and then what we do is we break it into, so I'm going to say this is the face and this is the market. So what I do is I take the 250,000 and this is an interest rate table. This is an interest rate table that we can use, or on any test or homework it'll be given to you. You can do it on a calculator. I'm just doing it for the so that we can see. These are present and future value tables. And so what we want to know is, what is the present value? Let's say this is a 10-year bond. What is the present value of $250,000 that I pay at the end of every 6 months? Well, this table is calculated. You'll notice it says periods. It doesn't say years. So it's going to be 20 periods because it's 10 years, right? Because I'm paying every 6 months. And so 20 years, and it's an ordinary annuity. Ordinary annuity means I pay at the end of 6 months. An annuity due means I pay at the beginning of 6 months. Bonds are issued as an ordinary annuity. I pay interest at the end of every 6 months. So for 20 periods, I take the market interest of 4% and cut it in half. So I double the periods and cut the interest rate in half, and I get a factor. I don't know if you can see that. My finger there is 16.35143. So I'll multiply this by 16.35143. And I get 4,087,857.50. Okay, and then I'm going to take the 10 million face value, and I do the same thing, except instead of the ordinary annuity, this is just a one lump sum. We're cutting it in half. So I want the present value of a lump sum, present value of $1, 2%, the market rate for 20 periods, and I get 0.67297. So that'll be 6,729,700. Then I add these two together. Gives me 10,817,55. I'm just going to round that up to 8. Okay. And this is the amount of cash I will receive. And so I'm issuing it to a premium because my face value is 10 million, but I'm receiving 10,817,000 because the interest rates have dropped from 5. Remember, I'm paying them 5%. So I'm paying them 250,000. The market wants less than that right now. That's just market forces. And so my entry on that will be cash will be 10,817,558. Then I will have bonds payable will be for the $10 million because that's what I'm paying back at the end of 10 years is $10 million. So you say they're losing this $817,558. No, what they're doing is they're getting more than 4% because the market's demanding 4%. So they're getting more than 4% to make up for that $817,000 loss. And so this is a premium on bonds payable for $817,558. All right. So that's our entry to record the interest. All right. So what happens then when I make my first interest payment? Remember, we decided I'm paying $250,000. So on my first interest payment, so 6 months later, I'm going to have interest expense, and I'll show you how to figure that in just a second. And then I'll have the amortization of the premium on bond discount. And then I'm going to have cash. Well, that's the one we already know. The cash is going to be $250,000. That's what I'm paying. So what I do is I come up here to this 10,817,558, 558, and I multiply that by 0.04 and divide that by 2. Oops. Divide that by 2, and I get an interest expense of 216,351, and I'm just going to leave it at that. Don't worry about the penny. Now, our debits and our credits always have to equal, so we just plug the difference. So I get 33,649. That's how much of this amortization, this bond premium, has been amortized. So I pay 250,000 to make up for the fact at the end they gave me 10,817,000, but I'm only giving them 10 million back at the end of 10 years. And so that's my entry for that. Now, this amortization, what happens is this number goes down. I then subtract this amortization so that the carrying value is this 10,817,558 minus the 33, and then that's what I'm do times 4%. This is where Excel becomes your friend. But you can do all this in advance on your bond amortization. You can set up a bond amortization schedule and do all this in advance. All right, so that is if I issue it at a premium. Well, what happens if interest rates move the other way? By the way, I use the interest rate that was set at the time of issue. It doesn't matter what interest rates do after this. So interest rates could go to 8%. I still use the 4% for the market interest for that. It's the date of issue is what's important. Okay, so the same scenario. I issue a 5% bond, but this time the interest rates went the other way and are 6%. Okay, so I've got 250,000, and this time I want the present value of an ordinary annuity. And so remember, I'm cutting in half and doubling the number of periods, so it's 3% for 20 periods, is 14.87747. And when I calculate that out, I get 3,719,360. I'm going to round that up to 8. It's at 5. And then I'm going to have the $10 million, and that's the lump sum I'm paying back. So I want the present value of $1. 3% for 20 periods is 0.55368. And when I multiply that out, well, I just get 5,536,800. And I add that to the 3,719,000. Add those to something's wrong. I get 9 million to something's off there. Let me do that again. 3,719,368 enter. 5,536,800 plus get 9,256,168. All right, but at the end of 10 years, I'm going to pay them $10 million. So I'm issuing this bond at a discount. So I'm going to have my entry will be cash, 9,256,168. I'm going to have bonds payable for 10 million. And of course, we have to we always have to balance. So I'm going to have a discount on bonds payable for 743,832. Okay, so that's my journal entry to issue these bonds. Okay, so what happens when I make the first interest payment? So now I'm going to take this 9,256,000 and I'm going to multiply that by 6% and divide it by 2, and I get 277,000. So I'm going to have that my interest expense is going to be 277,685. Remember, I'm paying cash. We already determined that of 250,000. And of course, I have to balance. So I'm going to have the amortization and that's going to be 27,685. And we balance our debits and our credits now equal. All right, so that's the issuing of debt at a premium, at a discount, and of course we did the one at the beginning. Okay, so so that's all good. Now, if we are the issuer of a bond, we don't have to do anything but these regular interest payments. We don't have to update the price. If we are the purchaser of a bond, then it depends how we classify. Remember, I said a private placement, maybe an insurance company. So a lot of companies buy bonds for various reasons. And so there are three categories I can categorize a bond, either as a trading security, a available for sale security, or held to maturity. Only bonds can be held to maturity because stocks don't have maturity time, right? So it'd be one of those, if it's held to maturity, I don't have to do anything but record the period. If it is available for sale or trading security, then I have to do what's called mark to market, and I am required to recognize the gain or loss. If it is a trading security, I mark the gain or loss on the income statement. If it is a available for sale security, I mark the gain or loss in the other comprehensive income portion. So that's how I handled that. obviously the interest expense is what gets recorded on the income statement. Um, so that's interesting. All right. Um, what happens if I repurchase a bond? Like I want to clean up my balance sheet for some reason or do some things. What happens if I repurchase it? Then I will repurchase it at the market rate and I will recognize the gain or the loss. And so I will have to get off the books the bonds payable, the discount or premium on bonds payable, and then record a gain or a loss on the repurchase of bonds. um, so obviously, if it's a gain, my retained earnings goes up. If it's a loss, my retained earnings go down from that. That's part of that. We're going to look at the quality of debt. There's actually a chart in your book that I think is really great. If I were you, I would make a copy of this, just stick it away somewhere that you can use it. But they talk about quality of debt, so we're going to talk about some um, more ratios here. But it's my page 7-18. It's exhibit 7.3, corporate debt ratings. So you have the S&Ps, the Moody's, the Fitch, and so here's the different ratings by the different companies. You can see S&P and Fitch are pretty much identical, not quite perfectly identical when you get down here to this. Notice that anything that is triple B minus or above is considered investment grade. Anything double B plus and below is considered non-investment grade or high yield debt, or some people just flat out call them junk bonds, right? um, but anyway, that's a chart that as you go through your career may come in handy because I can never keep in my head exactly straight, particularly how S&P to me is pretty straightforward, but Moody's, they're big A, little A's, 1, 2s, and 3s. That always gets me a little bit, what's that equal to? So you might want to keep that hold. So we're going to look at some ratios that are used when we talk about liabilities. And I'm going to go to the back of your ratios first. To me, when we're looking at short-term solvency, how well can a company pay its bills? And we look at the short-term solvency of the company. One of the big ones is the current ratio. And that is simply the current assets divided by the current liabilities. Now, there is some fluctuation about what's appropriate depending on the industry, and there are books you can look up what each industry should be and this and that. But the general rule is you want this to be at least 1. You want at least as many current assets or more as you have current liabilities. Oddly enough, you don't want this number too big. Because then that means that you've got too much cash and near cash, probably have too much cash and near cash on hands and are not employing it to its best and highest and best use. That the next one that comes along, your book calls the quick ratio, and that is a common term for it. But another term for it is the acid test ratio. And that one is going to be cash plus marketable securities plus accounts receivable. Divided by all your current liabilities. So that's an important ratio. And again, you want this number to be as high as possible. It's okay if it's a little bit under one. Obviously, you're taking the reason that we use this is because the biggest current asset that we're taking out is inventory. Matter of fact, some authors will say that it's current assets minus inventory is another way to get there, but your book uses this formula. But the biggest one we're taking out is inventory, and the reason that we say is that inventory is not particularly useful for satisfying current liabilities, because in so many, imagine if you walked into Walmart and there was nothing on the shelves, what would you buy? Nothing, right? So you're going to have inventory in order to operate. That's the concept behind the quick or the acid test ratio. So that's a big one on liquidity ratios. Then the other ones that you have are called solvency ratios. Your book called capital structure. A lot of people call them solvency ratios. The first one your book calls liabilities to equity ratio. Okay. And so a lot of people will call this debt to equity ratio. And so it's just your total liabilities to your shareholders' equity. Debt to equity or liabilities to equity ratio. Then your book has one called the total debt to equity ratio. It's the long-term debt plus long-term leases, including the current portion, and short-term debt and leases to stockholders' equity. So what are they taking out here? They're taking out the current liability. So this is your long-term debt to to that. And so it's really, to me, it's almost the same thing on that one. Another good one is times interest earned. And so we use our friend EBIT, earnings before interest and taxes. And that's just EBIT divided by the interest expense. And this tells you how many times your earnings will cover the interest that you're paying. Again, the higher the number, the more solvent the company is. And then the last one that we have is the cash flow from operations. To debt. And that's just cash flow from ops to total debt. Now, you will remember one of the first lectures I gave you. One of the things I said that if you understand all of the financial statements, the income statement, the balance sheet, the cash flow statement, you can essentially generate the statement of shareholders' equity from the balance sheet. Um, but if you understand the financial statements, and this was the caveat, they are not lying. It's hard to, if they're just making up numbers and putting them on paper, then, God help you trying to interpret what's going on. But assuming they're telling the truth, which, as much as the scandals um, get a lot of credence, get a lot of press time and coverage and all this kind of stuff, they're actually pretty rare. I would say 98, 99% of the time. The numbers that you're seeing reported are legitimate good numbers. There may be some funky stuff around the edges, but the gist of them is pretty good. This is one, right? Because when a company is going out of business, they will generate a lot of cash from. That's when they're generating cash from investing because they're selling their investments, right? Their property, plant, and equipment, their marketable securities, all this kind of stuff they're selling. And so you're looking here. If you know this ratio shows you the cash from operations. So the operations in general is what is likely to be continuing sustainable money, right? So if your cash flow from operations is a good number to this total debt, so that you have that, then it's, you can say this: I can have lots of cash if I just have cash flow to debt. Well, that could be, but I'm selling off all my assets. But cash flow from operations, none of that comes from asset sales. And so it tells you the health of the company servicing their debt from a sustainable source. So anyway, that's the overview of this chapter, and I hope that helps you out a little bit. And I'll come back and work on some problems here. So good luck to you, and let's see let's see. I believe our next homework and everything is due on June 22nd. Let me check the calendar here real quick. Yes, that's right, June 22nd. So, don't let down. Stay up with it. And, good luck to you. This, particularly that pricing liabilities, it's a little bit hard.